All right. Good morning, everyone. Dan with the Tradingology Trading Room on October 3rd.
Good morning.
Hey, good morning, Dave. How you doing?
Good, good.
And just as I was clicking start, wham, there goes the market.
Unbelievable.
Yeah, I wasn't doing a whole lot, so I was actually looking at the overnight activity. I was like, okay, let's see if we get some little rebuild today. And all of a sudden, boom. Did someone just drop a bomb on something or what?
Yeah, no. I'm looking for some news now. See what's going on.
200.
That's the. That's probably the only thing that would send the market lower here. Yeah. At this when the market is really kind of 173. When the market is vulnerable and it's in a downtrend, which has been already established the last few days. We have MT volatility going higher.
It's got a lot more room to go higher too, right?
Yeah, and it's got room. So I don't see, disappointing service economy reading. That was one of the news points. I was in the in the RT US. I was talking about a potential news shock, but I wonder how bad the service economy reading was. Let's see.
Yeah, that's a 200-point drop on the YM.
Yeah, that's crazy. Wow. I think we could be at the beginning of a real bear market here. But look at that. Oh, what happened to the ES? UNZ? It gapped higher. What is that? Oh, you're on a tick chart. Okay.
Which one are you looking at up
The
here?
one, yeah, the ESE.
It did just gap up there, yeah.
Yeah, that was kind of weird.
That is interesting. I don't think I've seen that yet on the tick charts.
Yeah.
Wow.
I noticed on the advancing decline line, the ADVN minus DECN yesterday, I think it was, or maybe it was the day before. There was a gap down on that. That is pretty rare too. Yeah, on a 5 minute, right there, right to your left, right where it dropped. There's two large bars.
Right.
There's a gap in there. That is very rare on the advanced decline line.
Wow.
Yeah, very rare. And I knew
Jared says ISM numbers. What's the ISM stand for again? I forget off the top of my head. It's still early for me.
something service manufacturing or
That's
something.
one that you were talking about. Okay.
Yeah, it's the one I was talking about. The Institute for Supply Management, ISM.
Jared's got the numbers 52.6 versus a 55.3.
Which is not, I mean, yeah, okay, it's weakening, but yeah, well, see, when empty volatility is rising, there's another gap right there on the UD vol too,
Yep.
and on the advanced decline. Holy cow! Look at that gap. So what happens is you get, empty volatility is rising. That's where these shocks can come in, and they can show up in really unexpected times, and that's what happened. So. I'm a little skeptical, though, of a market drop on news. I'm a little skeptical, but we'll see what happens.
Yeah, especially that one.
Yeah, I know a lot of people follow, but it shows weakening in the economy, definitely. But still, on a news event of any kind, I'm very skeptical. We'll see what happens, but
Yep.
I typically that kind of a drop on a news event doesn't last.
400. Wow. 450.
Yep. Yeah, it's pretty darn low. Those gaps, though, in the advanced decline line and the UVol, DVol, unusual. I don't think I've seen those in years. Years it's been. What's the spread doing now? I haven't checked that because I'm not trading the spread today. Yeah, just kind of sideways. It should be. I mean, we've had 2 negative days, and the spread has been negative. So you had I think you had the insight a few weeks ago that when they're both negative like that, or all three are negative, that indicates a potential turnaround in the spread. So
Yeah, and this was 2 days back to back, right? I'll pull over the spreadsheet here that we actually saw this occurrence now, where it's rare. 2 days in a row, both markets were down for the Dow and the NDX,
right,
and the spread was negative. That typically does not happen.
right.
So eventually, that typically signals, like you say, a reversal. Usually the next day, the day after.
Yeah, and what kind of a move have we got on the spread right now? And this is another reason why we do the spreads is because yeah, it's not much. It's like what? I mean, on the net. So we got about a half an hour. If you can pull up a 30-minute on the spread, see what that is.
I can switch us to a 30-minute.
Yeah.
Yeah, this is where you don't get killed. If
Yeah.
you're long or short one, even though it moves 200 points, so is the NQ. So you're long one and short the other. That's the basics, right?
Exactly. So this same scenario happened, I think, in the spring. We pointed it out that the markets just went absolutely insane, and they like shot up like 200 points in like 5 seconds, but the spread barely moved. And so that's why we do the spread. And if you get good at it, you're going to protect yourself from a lot of pain. Morning, Mike. Morning, Jared.
Hey, good morning. Yeah, looking at just the oscillator numbers, we're 0.04, 0.05 in these 2 minutes, or the 2 bars, and
Yep.
a 1.4 pre-market. So yeah, not a huge move at all.
Yeah. Oh, I'm sorry. Jared says that the expectations for ISM were 52.6, or the actual is 52.6. I thought she said 56 point. Okay.
Oh, so gotcha.
That is a pretty big drop, 55.3 to 52.6. Yeah, that's a big drop. Yeah, that's why people, and it's funny though, the number comes out and all of a sudden everybody hits the sell trigger. What the heck? Everybody's that fast.
Yeah, right.
Yeah. It's like, oh, okay, everybody must have had their finger on the trigger. It's like, if it's negative, I'm shorting. I'm selling. I'm out. I think that's a bunch of crap. I think that most of the trading is done by algorithms, so they must have programmed it. Said, hey, look, if you see a ISM number below 55, sell.
If it changes more than 2 points than the expected, then do something.
Exactly. If it changes more than 2 points, then sell a lot. And that's the way those guys program those algorithms. I'm sure they were up late last night, putting in the parameters. Okay, more than 2, sell 100 million. If it's more than 3 or 2.4, sell 500 million.
It would be fun to get those insights to see how they do it exactly.
Yeah.
Or find someone that knows a guy or something. Morning, New Rug. Good to see you.
Those guys are geeks. They, they live on pizza and beer, and you just give them pizza and beer, they're happy. You probably got them tucked away in some undisclosed location. And Nurek, good morning. Yeah, very interesting stuff. So we're getting some bad news here. We had did you see the tariffs that they announced yesterday?
I did not, but I just see the Dow's down 300 now already.
Yeah.
Sorry. Got squirrels running around this morning. Squirrel.
Yeah.
So that means, because we're 260 on the YM, but 300, 318 now on the Dow. Everybody's over 1% already negative, and there it goes more. Tariffs, what do we see?
Yeah. So yesterday, Trump has infiltrated and expanded tariffs to the EU, taxing some of my favorite things.
Oh, whiskey, cheese, and wine?
Yeah,
That's just not even nice.
that's not nice. No.
25%.
Yeah, come on. If I don't have my Parmigiano Reggiano, I'm not happy. And wine, please.
In retaliation for the aircraft, he goes after the booze.
Yeah. So this is a expansion of the trade wars. Christine Lagarde, who is the chief of the IMF before she's taking over as the chief of the ECB, European Central Bank. But when she was still at the IMF, she said the biggest risk as the head of the IMF that she sees is the increase in the trade wars across the world. And she made she did a speech at a manufacturing conference in Europe, and she said most of the EU was somewhat insulated against the tariffs, but there was already a they started to show a little bit of weakness in a few countries that exported to the US. And those exports were going to be taxed very heavily. And that really put pressure on those local EU economies. But she said it didn't stop there. And this was just on manufacturing parts. Because there are suppliers to those manufacturers that are sending products to the US. And I believe it was on car parts. I think it was car. And so there's suppliers to that company who's getting hit with the tariffs that's exporting to the US, who now also are being affected because of the tariffs on those car parts. Now we've got this. This is really see, I understand why Trump is doing this, and I'm not making any political statement here. We lost the edge in manufacturing in the 1980s. We just lost it. What happened at that time was low wages, favorable tax treatments were offered by the Chinese to American manufacturers. And when that happened, a lot of manufacturing moved overseas. A lot of it. I mean, it was so bad that we had in the United States, there was something called, what was it? It was a 507, Section 507 plan to retrain and assist displaced workers because of it. And they put billions of dollars into it. So all these guys who were laid off from manufacturing jobs in the US went through a retraining program. They tried to train them to do other occupations that, so they could find other jobs in the US or help them find other jobs. And it was tough, though. It was really tough.
Yeah, Don calls it out on the tariffs here. Trump was originally starting at 100%, so it came down off of that.
Imagine if he put 100% tariff on. Holy cow. That's insane. Yeah, that's crazy.
Well, that's how you negotiate, right? You start way on the other side and you come back.
Yeah, that's right. Well, Trump's a negotiator.
Right.
And so what he's trying to do, I think, and this is my idea, is that since we lost manufacturing in the 1980s, and I read a great book when I was the director of economic development for the city I worked in. It was a great book by Jane Jacobs called The Economy of Cities. And for a city or a state or a country to be economically prosperous, you had to have more exports than imports. Well, when we lost that capacity to export because we lost manufacturing in the United States, it also meant we had that the entire economy suffered because of it. Now we're no longer we were no longer net exporters, we were net importers, and that's why from like the 1990s on, China economy grew double digits, 10, 11, 12, 15, 18% year over year for a decade or more. And that was the reason, because they became the net exporter.
Yeah, and that's every business now today goes through it, right? Hey, we need to make something. Well, can we make it even, how do you compete with China? You got to look at manufacturing in China. And kudos to the people that keep things in, made in the USA, that want to do things here. But that's always the thing, right? Is, business profit and how you're going to run it.
That's absolutely right. Yeah, that's absolutely right. And in my position in the city, I called a lot of manufacturers in the United States. They're headquartered here. They were still headquartered here, but they manufactured everything overseas. And I said, bring back your factory. We'll give you tax credits. We'll give you, whatever you need. He goes, well, most of the people that I talked to said, I'd love to do it. You guys have a great area. You have a lot to offer, but the labor costs are so high that we just cannot make it economically feasible. We just can't do it. Labor costs were so low. I mean, they're paying like 25 cents an hour. I mean, those are 1920s wages.
Right.
So as much as I tried, I could not convince them to come back to the United States and manufacture. But so from that point, from the 1980s, early 1980s, mid 1980s, all the manufacturing went overseas. See now I'm going to use this as a contrary indicator. So is when the VA spread declines, I bet we're going higher on the markets.
That's what I was just looking at that too. It finally did start to set up potentially for a short the spread here.
Yep. And not only that, but I'm skeptical of news events in which the market sells off.
So yeah, these guys can absolutely rally right back up.
Yeah. But so when the manufacturing left, we were now net importers. That reduced it really kind of tipped the scales of the United States into a weaker position. And so now we had to print money in order to maintain the economy. We had to do, we had to, stimulate the economy. And then of course, when the 2000 .com bubble came in, because we were already printing money. I mean, Greenspan started printing money in 1987 on a very limited basis. It really boomed the economy. At least the first attempt at printing money really stimulated the economy a lot. It did a really great job. I mean, it created the .com bubble.
It's like the first time you taste sugar.
Yeah. Oh man, it's a rush. Anything you do first time is always going to be a little bit of a rush, right?
Mm-hmm.
It's great. It's wonderful. Of course, then after the bubble, and we got into the housing bubble in 2008, and now that little bit of sugar didn't go as far, and so we had to print a lot.
So what are we going to call this one? The credit non-repayment, or?
Well, hey, I don't know if you saw this or not, but I posted this chart on Twitter. Let me see if I can find it, because this little graphic here was pretty darn interesting. It really kind of summed up where we are. Here it is. I'll put the link in the chat. Yeah, this chart is really, really interesting. And it got me thinking that it's not just, so now, I mean, the QE 1, 2, 3, 4 that we did in 2008 and onward, that had an effect, but it didn't have as good effect as 1987. So the amount of effectiveness of these QE programs is getting worse and worse. This is it here. So what this represents is, you see the green lines down there? That's not the problem. those are the Fed fund rate repos and stuff like that, and the total balance is maintained with the Federal Reserve banks. It's that dotted line that shows where the baseline pre-crisis should have been. That's where the reserve should have gone to, and that's so the circle there. And this is the problem: is the huge gap between the baseline pre-crisis trajectory of wholesale funding sources has dried up, and it's really only the repo market. The repo market is down there, way down there, but we really need what's up there in the dotted line. Evidently, since they started quantitative easing, and you can see the date there where they kind of separated in 2008.
Right.
The requirements were on the dotted line, but what actually happened was a lot of the refunding opportunities in the repo market and other sources of liquidity. This is really sources of liquidity had dried up. People were not willing to lend their excess reserves if they're large banks, and they were holding the money back. They weren't putting it into the repo market. And so with all the quantitative easing, they didn't have to do that because the Fed was doing it. And so now we have this huge gap here. And now, of course, the Fed is in QT, quantitative tightening. And they have been since the beginning of the year. And now now the banks, now the banks don't have the other types of funding that used to be available pre-crisis. It's not there anymore.
Well, it's interesting too. I was reading as part of that whole repo stuff, what's going on is the four big boys in the bank market, they have it, but they're not lending it overnight. So
yes.
They're like, they're making that decision to say, nope, our money's better over here. We're not going to put it in the repo market. You go ahead and take care of that, Fed.
Yes, exactly. Yep. They're getting selfish now, they're saying, and also there's a lot of reasons, I guess, why they would not want to put it into the repo market at this point. They don't want to lend those excess reserves to other banks.
I think I read there was a quote of something like, hey, we're here to make money and not something else. It's like interesting.
Yeah. So they're really out for themselves. They don't want to get in a situation in which they number one, they definitely want to make money, and number two, they see better opportunities in putting their excess reserves into other investments rather than lending to other banks.
Mm-hmm.
Why would they do that? It seems like lending to other banks, even on a very short-term basis, you're talking about overnight lending.
Right.
Very short-term stuff. But they would rather not, because they don't trust, I believe, the other bank solvencies, especially the smaller banks. Although I've read other places that the smaller banks are probably slightly better insulated against an economic recession these days than the larger banks. So I don't know, maybe it's just the larger banks using their excess reserves to chase yield someplace else. Maybe they feel they can get a better yield someplace.
I have a feeling that's part of it,
Yeah.
where they're beating that 1.9 or whatever percentage it's set at currently.
Mm-hmm.
But we'll see.
Yeah, we'll see. But in any case, it's that chart shows a very large gap between what the baseline should be for reserves and what it really is, and that's a huge problem. So it's a liquidity gap. I call it the liquidity gap.
Yeah, because sooner or later they'll have to put some type of name on it, right? Because we had the housing crisis, we had the .com boom, blah blah blah. They need to put a name on it for the public within the next year. So there's probably a lottery going around to choose the best name for this recession.
Okay, I just named it liquidity gap.
Liquidity gap. There we go. We vote.
Okay, we'll spread that out across the world. It's the liquidity gap.
And it's surprising too. I was talking to my wife last night. We were talking about a few things. She's like, people at work are like, she's like, yeah, this recession and stuff. Jess, my wife, follows some things. We talk all the time, obviously. And she's like, yeah, I was telling some of the things that things are already starting. blah, blah, blah. And her coworker just started to cry. She's like, what's wrong? She's like, I don't want to live with my parents that much longer because they're temporarily living with them, so she won't be able to buy a house. So what does my wife do? My wife says, don't worry. It's going to be great because the stuff's going to drop. You're going to be able to buy a house probably with negative interest rates.
Yes. Yeah, that's good
She's
news.
like, what? How is that even possible? So it's interesting how it trickles out there. And yeah, the majority of people don't have a clue until it's after the fact, right? Because that's how you got to do it, or else there's panic and mass chaos. But just to hear that, she started crying because just the word recession, and she didn't want to live with her parents anymore.
Oh, you have audible notifications.
Yep.
That's nice.
Excuse me.
All right. Yeah, I just did a little post there, but yeah, I mean, what happens? Negative interest rates are definitely coming. Oh, there we go. Look at the markets. Look, its market's only down 100 points.
Coming right back. Yep.
Very skeptical of those news events. Very. So we'll see what happens the rest of the day. Let's see. What are the market internals doing? Yeah, they're not horrible. Advanced decline minus 910. I don't know. It's just going to be one of those days. See, there was a huge gap down on the S&P 500 yesterday and on the Dow. Well, not so much on the Dow because they rotate into it, but the S&P 500 definitely. They closed the day before yesterday's trade at 29.39, and they opened at 29.24. So there's a 12-point gap there in the S&P 500. I think is going to get filled. I'm thinking we're going back up to around 29.39, 29.40 to fill that gap. Maybe. Just an idea.
Well, that's all you got to have, right? Yeah, you were talking UDs, internals, definitely. No trend there. Big reversal after that gap.
Yep, and the SPX, if you got a chart of the cash index there on a 10-minute.
I got the down the NDX. I'll pull up one of the SPX here.
Yeah, the SPX is the one I was referencing with the gap down from yesterday.
Yeah, and we know how much the market likes gaps.
Yeah. Yeah, I don't know what that is. It's some phenomena where they like to get filled. Definitely.
Yeah, it's like some odd void that they can't deal with.
Yeah.
It's busy. I just made it so don't worry. We'll zoom in. Oh, yeah, there it is.
Yeah, on a 10-minute. Oh, yeah. Well, you can even see it on the daily, of course. Yeah. So, yeah, there's about a 12-point gap there.
I still got my zero line. See, that's a really old chart I was dialing in.
Yeah, you got an old one there.
Where? Oh, wow. Yeah.
Yeah, you see that? That's about a 12-point. I think it's about 12 points there. So, yeah, I think we may.
Huge.
Yeah, we may end up going back up to that 29.40 level, if possibly. I don't know. It depends on how weak this market really is. Now, if we're going into a real bear market, if we do go into a real bear market, that gap may not be filled. So it'd be interesting to see if that happens. If it does not happen, if we do not fill that gap, that is hugely negative. So that gap must be filled in order to say, okay, well, we're probably just going to go sideways and up and down for the rest of the year. But if that gap does not get filled and we continue to move lower, that is a huge negative signal for the overall markets. And I don't know if you remember, but back in July, I wrote a report for Strong Market about the all of the dates and cycles for big declines in the market, and how this kind of is very similar to 1929,
Mm-hmm.
1929, 1919, or I'm sorry, 2019 and 1929. They end in a 9.
Right.
And we also had the event where we had that 4% drop within a single week in the market. And that was back in early 2018.
Yeah, twice, right?
Twice. Yeah, we hit 4% down on the downside within a week of each other. It's a rare event that spelled the decline, that basically signaled what was going to happen in 1929, huge bear market. And we had the same thing happen in early 2018. And I think the reason why it's taken so long for the market to really feel the effect of that is because of quantitative easing and the Fed stepping in and doing all this crap. But yeah, I think it's going to come home to roost. I think it's going to eventually hit the market really hard.
And you know what else is no longer happening that's causing, or as a contributing factor, right? Is all the corporate buybacks that have stopped or are stopping.
Yeah, and that's been fuel for the market.
I think that's the other thing that propped it up, that kept it up this last year.
Yeah, that's a whole nother thing. Good morning, Isham. Yeah, that's a whole other thing there, because think about this. If you were a company and you had a few $1 million, what would be the highest and best use of that money? Well, if you thought the economy was going to be good, and if you thought there was opportunities in the market, you would probably put it into research development or marketing or something else that's going to generate revenue for the company, right?
Exactly.
Instead, these companies, and there's been massive buybacks over the last 5-6 years, have put it into their own stock, buying it up, propping up the share prices. So they could not find a better use for their money, which is it's been a huge negative signal for me for many years.
Yeah, I watched that entire video of Danielle and the more I hear her, it's like, wow.
Yes, everyone should watch that. Really good stuff.
She really is proud of her newsletter, though. Have you taken a look at that?
I looked at her offering. It's not terribly expensive. I think there was one offer for $50 a month or $500 a year or something like that.
I might have been looking at one for more offers like 5,000. I'm like, what is this? I'm like,
oh yeah,
so in here.
Yeah, she had a couple different offerings. One was $5,000 a year, and I think that was like more in depth kind of.
It has to be, right? There's no way, right? You gotta get the value out of it.
Yeah, and then she had one that was kind of like really, really very simple. Just probably for $50 a month, you probably get like 2 lines in a chart.
I am going to get her book and read it, though. I'm interested.
Yeah, I think she's very, very sharp. On Twitter, I subscribe to this service. It tells me who the 3 most popular people on Twitter that like my tweets. She was one of them this month.
Nice.
Yeah.
I think I saw that.
Yeah.
Well, you're popular.
See, look at that. We're going right back up again. I'm telling you, I'm telling you, man, these guys, I hate the news. I hate trading on the news. This is just basically a little bear trap there, just to get everybody in there short, especially retail traders, and then.
Well, they all knew it too.
Yeah.
They went short and they took it down 300 points, then bring it right back up 200. So there's 500 points to be made.
Yeah, they sucked the life right out of the retail investor. There's not many of us left.
And they said, okay, we made our money. Let's Let the retail market handle the rest of the day.
Yeah. Yeah, it's 10:30, so I mean they're going to be breaking for lunch in about 25 minutes. So nothing to see here. Come back at 1. Come back at 1 when they're done.
Yeah, pretty sideways chop, even if that little opportunity we saw was a small profit one. So as soon as this came back, exiting that trade, if any were potentially to take that one. Now that we're sideways, it's not really a good opportunity to get in again.
No.
We want these guys trending one way or the other. We don't want them sideways.
Right. Yeah, I don't think I think that news event kind of threw everything off. But let's see, you got the spreadsheet there. Bring up the spreadsheet. Let's take a quick look at that. I know it's going negative in the first couple columns on the binary trend, but
Drones and current. What do we add here?
Yeah, I'll read them all for you.
Basically 26,000, right? 25,998, I think I see on the Dow.
Yep, and NDX is at 75.38.
Filling her out more, yep.
Yep, filling out.
Cross-column is still holding strong at 8. Look at that.
Yeah, that's interesting. Yeah.
402 coming down to a 0. Yeah.
Interesting. Yeah. And we're negative on the spread there. Yeah.
Oh.
3 days in a row. Weird.
Go back and look. I don't think that's ever happened where it's 3 days in a row.
Yeah.
Somebody was asking me, I don't know if he's in the room or not. Someone shot me an email saying, hey, how's it possible that I have different numbers on the vol arb spread between like the old version 1 and version 2? The only way you can do that is bad data. Those should always line up if you're looking at the version 1 still. That's simple math there.
Yep. Either way, it should be lining up.
There are different bell curve numbers and different binary trend from version 1 to version 2, but that should absolutely be identical.
Yep. Column B, C, P, and the spread should all be the same. And AMAN, and of course the Dow and the index closes. So you better check your numbers. You may have transposed one like I did one time. Which
it happens to the best of us.
Dan caught. Yeah, I wish. Yeah, we're only down 26 points now. Jeez.
Nothing to see here. What do you mean there was a market drop?
No. It's just a figment of your imagination.
I know what you're talking about. We're still up here. This didn't happen.
Yeah.
Only 86. I don't know what that Dan guy was talking about. 300 down.
Yeah.
That's crazy.
Well, also
still down. Look at that. They're still at 2%.
Yeah. Wow, that's interesting. Yeah. Japan usually follows us. So we were down yesterday, so they were down last night. I think they should be closed. Yeah, they should be closed now. But yeah, the futures, see, the cash index is down 100. Futures are only down 50. Well, fair value had them down 100 or down 30 this morning. So now we're like 50 apart. So that gap has to be filled probably by the end of the day. That's why whenever the futures are down less than the cash index, I'm skeptical as well. We talked about this before. Usually the futures are right. The futures were pointing higher already as we're down like 250 points or so. The futures were only down, or the cash index was down that much, and the futures were only down like what, 220, 230.
Yep. All right.
But if this is the kind of volatility that we're going to be expecting, I mean, look, October is
not a good month.
Not typical. Last year it wasn't a very good month, and we may get a repeat of that season this year. We'll see. Maybe even worse.
Yeah, we're going to start to call it the Halloween scare in the stock market.
Mm-hmm.
And the spread's just sideways.
Yeah, it's just sideways. Yep.
You guys are a quiet bunch this morning.
I know. You guys got any questions here? Any comments?
We're gonna start calling you E.F. Hutton.
You remember those old commercials?
Oh yeah, those were hilarious.
Do you remember the Financial News Network, FNN?
I do not remember that one.
Yeah, it was a precursor to CNBC.
Okay.
Yeah, that was pre 80s, maybe. Yeah, mid 80s.
Sean's got a question about the RTY. Excuse me.
Yeah.
Mine has seen that too. Try putting the exact contract on it, Sean. Like put the Z19 and compare that, or take it away, one or the other. I forget what it was in the RTY. I think that's what I see cause mine.
Are you guys interested in gold at all? I'm sure you guys are interested in gold, right?
Everybody likes gold. I just saw little people where it was going there.
Everybody likes gold. Yeah, what's gold doing? Let's
Boom.
up, up. Yeah.
Nothing to see here. It's coming back down. But yeah, that was as soon as the market tanked, that really shot up. So the algorithm said, pull your money out of here and put it into gold is what that algorithm did.
Yep, and only do it for 10 minutes.
Yep.
And then get out.
Then bring it back.
Yeah, short-term trade. Well, I don't know if you guys know, but recently the central bank gold agreement that was established in 1999 was canceled, not renewed this year.
Yeah, first time in how long?
Since 1999. They established it in 1999. They renewed every 4 years. And then this year they decided not to renew it. For those who don't know, the agreement prevented wholesale selling by European central banks, so that prices wouldn't be driven lower and destabilize the market. It was renewed from 1999 when they sold it. Gold was at $290 an ounce. The agreement was renewed every 5 years with reduced restrictions on the selling in each year. And then this past July, they said, no, we're not going to renew it in September. So September 30th or 31st, whatever ended, the end of September, they did not renew it. And now they're off this, the gold agreement. And what it means is that they can sell gold again. Well, they have, when they established this agreement back in 1999, when gold was at $290 an ounce, gold prices rose 13% in 3 days because I guess the market interpreted that as having confidence. You know, hey, you know, the European central banks are not going to be selling gold. This is great. So prices, you know, everybody went in and bought gold and, you know, up 13% in 3 days. But it did not stop the central banks from actually selling gold. And this is the part that you will never probably read in any of the news stories that you pull up on this agreement. What they did, they were limited to 400 tons of gold a year. The entire ECB, all the central banks in Europe could not sell more than 400 tons of gold in a year, but that didn't limit them because what they did was they basically leased gold out. So if somebody had to borrow it for collateral in some way, they actually loaned it out. So essentially selling it. They loaned it out to other countries. They loaned it out to, I think Venezuela was a buyer. And recently, Venezuela tried to get their gold back, and they said, no, you can't have it. Interesting. But that's what happened. So now they're saying, and so for what they did was in 2008, 2009, during the financial crisis, they leased the gold out, selling it essentially, raising capital, raising the cash reserves that they needed. So they used it as a funding mechanism for quantitative easing. After the financial crisis, they went back and they started buying gold again. And they've been net buyers of gold since the crisis, so about 10 years now. Now they have not renewed the agreement, so now they can sell as much as they want because they know a recession is coming, and they need to have that. They don't want that agreement in place anymore because they know if they need to raise liquidity, if they need to raise cash for the upcoming recession, they may have to sell a lot of gold. But I don't think that's going to affect the price very much. I think what it's going to do is actually, during the recession, gold prices will still go up, but it will, I think, dampen the gold market a little bit. And that's why I'm more bullish on silver than I am on gold. Isham says the cloud appears on the lower time frames, but not on the weekly time frame for some reason.
Let's see. Let me do a quick test on mine, Isham, on the sideline here, and I'll see what I see. That might be one of our final questions that I can cover. Stand by. Yeah, I do see just even pulling up the Curious wiki page, I do see the 400 tons. It's always fun to see it as TONNES, about how much they could limit.
Yeah, that's the European spelling, right?
Yep, just like centers backwards and all that good stuff. Sorry, guys. Sorry, my friends over in Europe.
You guys are all backwards now. That's the implication. Oh, no. Actually, they're probably, we took over and just bastardized their language.
Right.
They're spelling it correctly. We just like Americanized it.
So, Isham, I can tell you this. Make sure if you're on the weekly, just put in the RTY. Don't put in the specific. I just added it to my weekly chart here, and the Renko is definitely drawn in.
That's
so just for the weeklies, just have the long symbol. Don't have the exact because it's too long with the contracts changing quarterly.
Yeah, I guess that's the deal. Yeah.
So there's your answer.
I think the RTY is going to get crushed here. I think it's going to be much weaker than everything else. It is on a percentage basis down 0.70, and everybody else is back up to like 0.25 or 2.4. Yeah, the small companies are going to get hit the worst. That's always the first index to really drop sharply in a recession because they're smaller companies. They don't have the ability to withstand pressures from the recession as much as the larger cap companies do. So, if I was to take long-term positions, I would short the RTY first, NASDAQ second. Those two are going to get hit very, very hard because the NASDAQ, tech companies, speculative issues, consumer-driven economy with technology products, going to get hit very, very hard. The last ones that I would short is the Dow and the S&P 500 in that cycle.
See, I was just a week early last week when I took that short. Look at that drop down. Now we're red on this week, red on this week, red on this week for volume.
Yep.
Bam.
Yep.
All right.
All right, guys. Well, thank you for joining us today. We're going to wrap things up here. Dan, I know Dan's got to prepare for a meeting, so we're going to wrap things up. I hope everybody has a great day. Today is Thursday. Have a great weekend.
Yeah, hooray for commission-free trades, Mike. You got it.
Are they doing? They're doing commission-free on stocks, not options, right? Not options and futures. It's just.
Yeah, I don't think it's across the board yet. It's just stocks, I believe.
Right.
But we'll see what the future holds.
Yeah, that's pretty cool. All right. All right, guys. Have a fantastic weekend. Dan, have a good one. We'll see you guys next Tuesday.
Appreciate it, guys. Thank you, Dave.
Yep. Thanks.
Bye.